Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, this might be the most important podcast we've done to date. Let's get into it.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you have not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, guys. So the reason why it might be the most important podcast is because we're going to show you at least what Bob and I look at in terms of where we think this move in the market, this very bullish move, is going to end. So we're going to kick it over to Bob. He's going to show you some charts, then I'm going to show you some charts, and hopefully that gives you guys a good idea of when to gird your loins and start bracing for the downside in this market, because it is coming, just not quite yet. So Bob, what do you got for us?
Yeah, hey, let me show you some charts. So Phil, before I start showing these charts here, at least I want to try to explain it to people. So the way I look at this is what I would call, there's a secular line, there's a cyclical line, and then there's a tradable line. This chart right now is weekly. So guys, we're super macro right now. And this is what we look at. We want to start gauging any kind of change in the weather pattern here with stocks or sectors. And so when you see this green and you see this yellow, this is long-term. Hey, am I looking to buy dips or sell rips? The bar here that you see here that's gray that I'm moving my cursor down on, this is more cyclical. This is long-term pivot, the green and yellow. These are shorter-term pivots with Fibonacci retracements associated with it. Okay, that's why you see the series of lines here. These are retracement levels. And this is the worm set at 13. But bear in mind, guys, this is a weekly chart. Okay, so it's tradable in the sense that if you want to take really, really long swings, then should be of interest to you. Okay, with that, what I want to talk first, I want to talk some of my early warning sectors, and then I'm going to talk a few futures contracts, and then I'm going to start talking about a couple stocks that I'm in with quite a bit of size that I watch very closely on. So with that, Phil, I'm going to start off with the VIX, the volatility index. And as you can see here is that from a long-term standpoint is that it's been trying to break out here a few times. It's been capped cyclically because basically they've just been selling volatility. So there's no warning system here. So we have basically secular sell, cyclical sell, and even some of these worm shots for VIX are short-term kind of tradable actions, and it's rolling over again. So nothing in the VIX tells you that we should be scared at the moment. You do get some of these moves here that caused some short-term pain. This was the October sell-off, okay? But what we're more worried about is more than an 8 to 10% correction. We're looking for when this thing starts to become real. So that's the first chart I want to show, Phil. The second one in my watch list, Phil, is TLT. This is the bond, 10-year, 20-year bond. Mm-hmm. And if you notice here, once again, if you're noticing a pattern here, Wall Street knows that these are things people worry about. They've been driving down the price of the 10-year, and the yields have been staying fairly elevated. In the past, you'd think people would run to higher yields, but in this case, what they're doing is the safety trade's not being played right now, Phil. So again, the secular standpoint, we've been driving down. Cyclical, we got up to a resistance area here, pull back. The only thing that's interesting to me now is the worm is up. The secular nature is holding on a higher low, and we're coming up to this resistance area. So if TLT breaks out, I'm going to start getting really nervous, Phil, and obviously I'll add my exposure to TLT at the expense of other equities that I own. The other area here too, and you trade this more than I do. If FXY starts getting, big pops, that means the carry trade is starting to end. And they've also been very, very good at keeping this from being competition from the stock market. Once again, there's nothing here to say, hey, we need to really start getting worried about, is the currency, basically the carry trade from Japan, is it ending anytime soon? Doesn't look like it at the moment, but that's what I'm watching. I'm watching for a break here. And again, to start skinning my size. Okay, everybody talks about NVIDIA. When's NVIDIA going to break? NVIDIA has been on a tear since basically the beginning of 2023. Okay, and it had a nice consolidation. This is what I call consolidation on high, secular green, cyclical green, and then you get these pullbacks to buy dips, pullbacks to buy dips. And then you had now, this is what I would call the blow off stage of NVIDIA. So now I'm watching NVIDIA for it to do the classic retracement. And again, if it breaks this area here, then I think the party's over, and then we'll retrace 85% of this. And this is what you want to wait for if you're not in a big hurry, and you don't want to front run. This is when you can get into NVDS when this one breaks here and you get a failure. So for a hedge here, and this is moving up as stocks move up. So this could fall $200 and still be considered a bullish catalyst, Phil. Gold, on the other hand, has been really trading in a pretty big range here for a while. If you notice, look at this range on this, okay? And it's been flipping back and forth from bull to neutral, bull to neutral, bull to neutral, but it's been holding above 1800. Now what we're watching here for, Phil, is we're in a bull mode again on gold. And that's why I said, worried about a crash. I'm more interested in a rotation here because what's happening with gold, it's breaking out of here. And I think if it breaks and flips, right now we have all three of them are in go mode, and I'm looking for gold here to do what NVIDIA is doing, is starting getting that parabolic move on gold. Oil, which I have probably most of my portfolio has been in energy, and even though the price of oil has been bouncing back and forth here, it's been a really, really good trade for me and my family and for the Trade Genius subscribers. And we're at a point now where oil has been, from a secular standpoint, it's been doing fine. Phil always talks about, we haven't talked about it lately, but Phil always talked about this $65 area being very, very important. If this breaks, you go out to a monthly on this, Phil, it shows $40 as support. So 65 area has been very, very important on oil. And again, if we get back down to the $65 area and we start to break it, I will abandon all of my energy names because we could probably fall another 30% from there. But right now, we've been in a tradable bull mode on this. We call this oil trade out. At the beginning of the year, it's been paying us off handsomely, and now we have to wait and see when it starts getting into this congestion here on resistance to see if it actually breaks out. The word on the street is that this should hold as a double top and we roll back down again. We'll just have to wait and see, but I don't care. I'm just looking at the charts, and the charts are saying that we need to own oil. At least still starts getting up into the upper 80s area. Natural gas, everybody's talking about when's natural gas. Phil, we're at our lowest natural gas ever.
Mm-hmm.
And interesting about natural gas is also a warning sign too. When natural gas goes, a lot of times it goes, the market is struggling. So they must sell natural gas as kind of a funding mechanism too, as a short, which is I find pretty interesting. But since the beginning of 2023, it's been no bueno for natural gas. I mean, across the board, secular, cyclical, tradable. Now, this is all on weekly. This is super macro. You can take this thing down to a 4-hour and hourly chart. There's plenty of trades in there. I'm just talking about canary in a coal mine here. Natural gas is in deep weeds until it gets above $3, until we can hit this resistance area, Phil. ExxonMobil, my favorite. Look at this. It's been trading like a metronome, okay? And it kind of broke this low here, and I call this a scare the children move. It changed the secular trend, but immediately gave a worm held above the cyclical trend. And now, I don't know if there's such thing as a quadruple high, Phil, but I think this thing's now gunning for 120, 121. And if it breaks that, we're looking for basically a $25 move to $145 on ExxonMobil. So once again, I think we're at a rotation here and not a sell-off. But if ExxonMobil breaks $95, $96 again, I'm out of here, okay? Because it's going to go all the way down into the 60s. Freeport-McMoRan, I've been banging my drum on this one, Phil, with the room. Copper and gold seem to be breaking out. Look at this move. This is sitting right here, ready to come to the surface. The worm has been green. It's been banging on this resistance now for better part of a year and a half. And if it starts flipping through 47, this is a $15 move to $62. I currently have a target of 52, but this could be a $15 move on the breakout. And EQT, because it's natural gas, even though natural gas is struggling, EQT is holding up well. They must be using the futures markets to generate cash flow while waiting on natural gas. But I show this one for people too because it's really not ready for prime time, time, but it's definitely tradable at lower levels. And I think the last one I want to show you is really interesting because we also starting seeing increased demand for gasoline. At the same time, supplies are starting to struggle, Phil. And this thing is ready to come up to resistance again. And if we start getting above this, nice little cup and handle on gasoline, you're talking 48 to 70, you're talking $92 for UGA. That's scary, scary, scary stuff for people to have to get to work. And once it breaks that out, I have 3 or 4 trades for people to take on this. So my view, Phil, is that from my perspective, looking at the commodity side of the house, is that looks like it's rotating into the commodities. And I'm going to flip it back to you because I'm going to let you talk about SPX and Bitcoin a little bit and see, where you think the worry signs and the worry price levels are for you.
All right, let's flip over to the SPX chart. All right, so here's a chart of the SPX. And before I get started here, guys, please hit like and subscribe. It helps us out on the channel. And also check out our specials over at tradegenius.co because what we're going to talk about here, this stuff's not going to be a surprise to us when we start to roll over. And so if you need help navigating this or whatever, just, we got a ton of options over at the site. Check out those specials. You can get into the room with us and we can help you navigate this stuff. So with that being said, if we look at the S&P 500, this is just a regular SPX chart, and this is actually on a weekly time frame. But I wanted to kind of zoom out and show you guys the personality, if you will, of the current move, right? So you notice things are very tight here, right? In terms of like the weekly bars are just a number of green weeks, right? They're not in giant ranges. They're just kind of stair-stepping higher here. If we do have a red week, it's very small range, more consolidation than anything else, and we continue to grind up. Looks a lot like what we saw that when we were grinding up after COVID, right? And this was a very accommodative time period from the Fed. They were buying the treasuries, which injected a lot of liquidity into the system. We're getting a similar form of QE in terms of the way Yellen has been distributing the short end of the treasuries. She's pushing out a lot of T-bills, which is short dated stuff, which acts as fuel for the market because that turns into collateral. So, that's kind of the big picture here. But what the point I'm trying to make here is that you don't really want to get in front of this move in terms of trying to fade it or short it or get out of the market too early, because this can continue on. As long as you're trending over the weekly 9 EMA, the show goes on. And so we can see that in the chart. You get these periods of that goes on. When you get a dip under the weekly 9 EMA, which we have not had in quite a long time, this move, even compared to the previous moves, even compared to the COVID squeeze, if you will, this is really, really, really a strong move up. And we just have not seen much in the way of basically a pullback in recent times. So what we wanted to do is kind of drill down now into okay, so what do we look for? Well, in the past, when we've had tops where things start to get a little dicey, and I can drill down to a daily time frame here. In black here, we have the daily 9 EMA. So we have a daily 9 EMA in black, we have a weekly 9 EMA in blue, and then below that we have the weekly 50 simple moving average. So EMAs is just a different type of moving average. It's an exponential moving average, so it weights the average a little differently than a simple moving average, which just takes basically the last so many bars and averages the closes across that. So the EMAs are nice because price tends to respect them. So what I look for is when we start to lose that daily 9 EMA, especially if we get a couple daily closes under it consecutively. To me, that tells me that the bears have at least temporarily moved in, and we're looking for a move that would sustain until we see strength back over the daily 9. Your first warning shot, aside from a couple daily closes under the daily 9, would be if the daily 9 starts to cross under the weekly 9. That's your first warning shot. Now, I will preface this with the fact that really we should also be seeing recessionary signs in our macroeconomic data. So we've shown you guys unemployment stuff, personal spending, consumer spending, manufacturing. If we're looking for a top, we got to start also seeing that macro data roll over. Now, it doesn't mean that we're not seeing signs already locally. I think Bob would agree that, we're starting to see recessionary signs on the ground, but you have to understand that until the big money, until the institutions decided it's time to shift, regardless of what we see or what we feel, really we want to time it with the institutions. So are we there yet? Well, we've shown you the macroeconomic data, not quite. So I'm of the mind that even though we should start thinking about this move ending, we're not there yet. So if we get a dip or if we get a 9 EMA cross under the weekly 9 EMA so if the daily crosses the weekly, that might be a dip buying opportunity on this first go. All right. So that's the point I'm trying to make. So we haven't seen that yet. We haven't seen that for quite a long time, since actually our bottom in October. even compared to previous QE periods where, the Fed's been accommodative, this move is a little unprecedented in terms of just a lack of a pullback to the weekly 9 EMA. So are we due for a pullback to the weekly 9 EMA? Absolutely. So yeah, we could see a drop. Currently we're trading at about 5250 on the SPX. That would mean that we would pull back to about 5100. It's not even that big of a drop. We're talking like 150 points on the S&P 500, a little over 1,000 points on the Dow. But if we do get that, I think ultimately, because it would be kind of like the first pullback in this overextended run, I think that's ultimately a dip buying opportunity. But as we progress in the year, as the macroeconomic data starts to sour, then what we're going to really start to key on is what we've seen in the past, where you start to lose footing over the weekly 9 EMA. Now, I think the top that we had in 2023, this local high, it's a little complex because you started to dip under it and you got back over the weekly 9 and you dipped under it again. So really what you're trying to establish is that, are we getting acceptance under the weekly 9 EMA? That's really important, because if you finally start getting acceptance under that weekly 9 EMA, like you had here, right? You basically now have multiple weeks of closing under it. It's not just a little dippy do, right? And your weekly and your daily 9s crossed under. So when you're in this situation, now it's like, okay, we got to be really careful here. This doesn't mean we're in a bear market. This just means that you need to start really actively thinking about hedging your downside risk. What do? We go down to the 50 SMA, right, on the weekly. Boom, huge support. So because we're dealing with high time frames, this stuff is a lot more reliable than, say, if you're looking at these moving averages on a 1 minute chart, right? That's way too noisy. When you deal with weekly charts or quarterly charts, this stuff has major reactions. So, like when this move came down into January of 2022, right? This was the end of the QE run with the Fed. They said, we're done with QE. We're turning it off. The net liquidity dropped, and this is how we rolled over. So I think in terms of like the actual market top, you can look at something like what happened in January of 2022. I think we're going to see something similar. So you're going to lose the weekly 9 EMA. You're going to get a first test of that weekly 50 SMA. And then this is what's key here is when you get that test, that the weekly 9 EMA, which is the blue step line, look how it acts as resistance, right? Price really can't get any traction over it. Now, if you're looking at the daily time frame, you might have a couple days where you poke above it. And when you're in the mix on the daily, it's kind of confusing because you're thinking, oh, are we breaking back above it? But you kind of have to step back and keep your higher time frames up on your charts to really, like, is it really accepting over it? And you can't really say that just because you poked above it for one bar that's really acceptance. You really need to see candle bodies above it, completely above it, right? So it can sometimes take a week or two to kind of establish that. But until you see that, until you see candle body completely over that weekly 9 EMA again, you have to think of it in terms of it's going to be a resistance area. And then ultimately we roll over, we break the weekly 50, and then we created a bottom down here, and we had what we call a lower high. So we did get acceptance. That's where, when you get into this condition, you have to be, okay, well, it's risk back on again. And that's fine, because sometimes that's going to happen. Tops take a while. You will get a lower high. You will even go through these transition periods. So it's not like a slam dunk, once we cross over X level, the party's over. It can be tricky as the market rolls over, but you basically have to just be like, okay, technically at this point, we're risk back on because we're above the moving averages. And that persisted for several days going back up, and then it rolled back over again. So then when you get back over here, you have to go risk off, right? That has to be your mentality. So you have to be adaptable, because this is what we call a transitory market, right? You're going from a big long bull market transitioning to a bear market. In reality, the bull market ended up here, but you don't know, right? We never know. Is this just another dip to buy, or is it really rolling over? So once we get the moving averages back under, right now we're dealing with being either, are we over the weekly 50 or are we under the weekly 50 on this lower high that we established? So it's kind of like you have to think of it in terms of, is the market is eroding, the supports are eroding. Now we're not bouncing off the weekly 50, we're struggling to stay above the weekly 50, right? So the market's kind of showing you its personality. And then finally we roll over, right? Then what comes next? Well, this is the weekly 200. I don't want to get too complicated with moving averages. It really comes down to the daily 9, the weekly 9 EMA, the weekly 50 SMA, and the weekly 200 SMA. That's all you need. So we come down to the weekly 200. Now the weekly 200 is really important in terms of bear markets, because if you're going to go into a bear market, a true bear market, you're going to find acceptance under the weekly 200. If you don't get that, then that's usually your big supportive bounce area. I think if you're going to take anything away from this, that is the one moving average that kind of separates big pullback versus we're going into a secular bear market. So ultimately, for our most recent, pullback in the markets, which ultimately bottomed in October 2022, that's where we bounced off of, was the weekly 200. And we never really looked back. And then now, you can notice too the chart, right? We had very good two-way price action. This is more what you would expect to see on a freely moving market, right? It's got good volatility. It's up and down. You see this a lot in the Bitcoin markets, because I think Bitcoin's a much more free market. But then you get into these things where it's like you're just in this giant move that it's very contrived. It can't really, the price action here, I think, is very obvious. It's much different than what you saw during the time period here, right? I would almost categorize it as price is trapped. It's just stuck in this channel. And a lot of this is derivative driven. You have gamma tailwinds from the options market. That's great until it breaks. And eventually all of these moves end up breaking. So the key is that, to kind of recap, we want to watch when we start closing under the daily 9, and then we want to watch our interaction with the weekly 9. And I think with good probability that we're going to bounce on the first test of that. Maybe we get that this coming week, maybe we don't. But if we do start to test that level the first time, you're probably going to get a bounce. But when we don't get that bounce and we start finding acceptance under it, and we start seeing the daily 9 crossing under the weekly 9, right? Then that probably tells you that we've got a date with the weekly 50. And the weekly 50 will probably bounce much like it did back here. And what we'll then have to look for, does the weekly 9 EMA act as resistance? And if you start seeing that, start to roll over and start to be respected, then you probably are looking at a period of time where we probably do have a bearish scenario forming, and we'll be looking for those bigger moving averages to start failing to support price. And for me, the transition from bullish to bearishness really starts to kick into higher gear when the weekly 9 EMA starts to find acceptance under the weekly 50. So this blue step line, you'll notice, came down. We had some transition going on, but ultimately now we're starting to stair step under that weekly 50. This is where your weekly 9 EMA turns into mega resist, and you're going to basically be bearish until you see price find an acceptance and pop back over it. In a bear market, this will happen. When you're in a bear market, you go from these bearish moves under the weekly 9 to what we call bear market rally. But ultimately in a bear market, you're not really going to pop above the weekly 50 at that point. That's what really separates bear markets from bull market pullbacks, is you just do not get acceptance back over the weekly 50 SMA. Now, where the bear market ends when you're in this scenario is when the weekly 9 EMA crosses over the weekly 50. And we basically got acceptance, and that really confirmed in April of 2023. So once we got that, regardless of what we thought, would come, basically it's the market's telling you that the bearish scenario is over at that point. And that was really the case. I mean, you never saw the weekly 9 cross under the week 50 after that. So these are just some simple things that you guys can look at. And again, we're looking at a historical chart. When you're in the mix and you're trying to interpret it real time, it can be a little more tricky. So again, if you guys need help with that, come into the room with us, because we are going to deal with this stuff. This is going to happen again. We're going to go through these transitions, and it might be a little tricky if you're not really seasoned with technical analysis, to navigate through these transitions. But once we get into the meat of the bear market, it will be very clear how things are going to go, what levels that we're going to need to clear. But I honestly think, guys, that when we do get into this, if we do get a recession, which we have not seen since basically 08 and 09, you're going to get a break of the weekly 200. Currently, that's down at 4,100 or so on the SPX. But not only do you need a break on that, but if you zoom out to like our past recessions, right, this is what those look like. You break through it and you're staying under that weekly 50, right? And you're under that weekly 50 for the whole bear market. And again, once the weekly 9 breaks back above that weekly 50, then you can kind of say, all right, the coast is clear. Pretty simple rules. Do you catch the absolute bottom and the absolute top? No. But if you're stepped out of the market up here and you're getting back in down here, that's a massive performance gain. So don't worry about catching the very top. Don't worry about catching the very bottom. You want to avoid the middle. All right. So you do that in this next go. When we finally do roll over, you guys are going to outperform the market. If you just did that once in the lifetime of your portfolio would outshine the market in terms of your lifetime portfolio performance. So I think we don't go through these periods very often. You just need to catch one of them really in the terms of your portfolio, and you'll be set. You'll be set to outperform the markets for the rest of your life. So with that, Bob, that's about all I had on terms of how to look for a bear market, how to look for warning signs when this rolls over, and ultimately confirmation of a bear market.
Hey, thanks, Phil. That was really good. And guys, is, it's important to understand the seasons. And when you're in the thick of things, you're going to talk yourself into and out of trades based on a recency bias, and just let the math work for you. You're going to do just fine. I think these next 10 years, if you're young enough, you're going to generate generational wealth by just being able to get out near the top and get back in near the bottom. And these bear market moves could be 2.5 years. So, it's going to be a lot of people are going to make a lot of stupid trades trying to catch the bottom of this thing. And our system and our insight will keep you from doing that. And you're going to be in good shape with a lot of capital to take advantage of the next upsurge. Plus, there's trades you can take on the short side that'll make you a lot of money too. With that, Phil, thank you. And we'll catch you guys on the other side.
Trade Genius.